When the earliest cryptocurrencies were nothing more than lines of code passed between dreamers, cryptographers, and renegades who believed the world deserved a financial system unchained from governments, no one imagined that these digital tokens would one day give birth to one of the most volatile, emotionally charged, and opportunity-filled markets in human history. And yet from the very first block mined on a quiet January morning in 2009, the same invisible force that directed the price of ancient spices, gold caravans, and stocks in the roaring 1920s began shaping the value of Bitcoin, the tension between supply and demand. But unlike traditional commodities, crypto's supply wasn't dug from the earth or printed in secret rooms, it was mathematically enforced, transparent, and predictable. Demand, however, was something far more turbulent, rooted in human belief, fear, greed, and the endless chase of future wealth. Long before any influencer posted price predictions or any exchange listed hundreds of altcoins, the earliest crypto traders operated in a frontier without charts, without order books, without the tools modern traders now take for granted. They navigated this digital wilderness purely on faith and community whispers, relying on nothing but the raw perception of value. It was here, in these chaotic beginnings, that the first true supply and demand battles emerged. When a miner who held hundreds of coins sold even a small portion, the market trembled under the weight of sudden supply. And when a group of early adopters spread news of Bitcoin's philosophical promise, demand surged in waves, lifting price in abrupt, breathtaking moves. Without even knowing it, they were establishing the very zones, pockets of imbalance, that modern traders now study to predict future moves. As the years unfolded and crypto stepped out of the shadows and onto exchanges, the market began to breathe like a living creature. Exchanges introduced order books, showing levels where thousands of buyers clustered like soldiers lining up to defend their territory, while sellers accumulated above, ready to strike down any attempt to push higher. These clusters, these zones, became the modern heartbeat of the crypto market, the places where institutions, whales, retail traders, and bots all converged in silent war. And just as in ancient markets, the past left fingerprints on the future. Whenever a strong move erupted, a sharp rally fueled by intense buying or a violent crash ignited by overwhelming selling, it marked the chart with regions where the imbalance was so powerful that price had no choice but to flee. In supply and demand trading, these were not just areas of interest, they were historical battlefields, yet crypto added a new dimension to this ancient concept, something no market before it had experienced: 24 hours of relentless movement, 7 days a week, without pause or mercy. There was no closing bell to halt a crash, no overnight gap to excuse a sudden rally. Every hour, every minute, every second price shifted under the pressure of a market that never slept. And this constant motion created unique patterns of imbalance. Zones formed at odd hours, in moments of panic, during periods of global economic fear, or when a single tweet sent millions scrambling. Traders began to notice that zones formed during high-emotion events were often the strongest. When Bitcoin crashed during China's mining bans or surged during institutional announcements, those zones became the pillars of future reversals, evidence of large orders buried beneath surface noise. It collapsed from another. He recognizes that behind the candlesticks are massive actors, hedge funds allocating billions, exchanges manipulating liquidity, whales accumulating in silence, and retail traders chasing shadows. Each group leaves a footprint. Whales accumulate quietly in deep demand zones, pushing price away in explosive rallies. Exchanges create artificial liquidity traps near supply zones to liquidate leveraged traders. Institutions leave massive unfilled orders at key imbalance areas, waiting patiently for price to return. In crypto, these dynamics intensify because of leverage, the very tool that magnifies gains but destroys accounts in seconds. But to understand supply and demand in crypto fully, one must return to the psychological foundation that makes these zones work. Crypto attracts crowds not just because of profit but because it represents hope of financial freedom, of escaping traditional systems, of rewriting one's destiny. This hope fuels demand in ways no market analyst can quantify. And fear, amplified by volatility, fuels supply in sudden cascades of selling. When Bitcoin drops even a few percent, leveraged longs are wiped out, triggering liquidations that act as forced supply injections into the market. These liquidation cascades create some of the most powerful supply zones, born not from human decision but from automated systems executing in milliseconds. And when price rockets upward, liquidating shorts and explosive upward squeezes, demand zones form in the wake of that violence. Throughout the years, every major crypto cycle, every halving rally, every bull run, every winter, etched new zones into the collective memory of the market. When Bitcoin broke above previous all-time highs, old supply zones transformed into demand zones through the psychology of regret and missed opportunities. Traders who once sold now rushed to buy dips, anchoring price in regions that previously acted as ceilings. This phenomenon, unique and beautifully cyclical, represents one of the purest expressions of supply and demand on charts, the transformation of resistance into support through emotional conviction. This is the beginning of the supply and demand journey for the crypto trader, a path that demands patience, historical awareness, and emotional resilience. For unlike traditional markets, crypto's movements often appear irrational, but beneath the chaos lies a structure more honest than any regulated market. Here, zones are respected because they reflect true market behavior, unfiltered by market makers obligated to maintain spreads or by regulations that soften volatility. Crypto is the raw truth of human behavior amplified through technology, and the trader who learns to read these zones learns to read the language of imbalance, understanding when demand is real and when it is an illusion, when supply is powerful and when it is a trap. He becomes a historian of price, studying old zones as ancient battlefields, learning from them, anticipating the next shift in momentum. This course, this narrative, is not merely instructional, it is a journey into the soul of one of the most unpredictable markets ever created. As the crypto market evolved from its early anarchic beginnings into a global financial ecosystem watched by institutions, governments, code-savvy innovators, and millions of retail traders, the shape of supply and demand began to reflect not only past price action but the shifting landscape of digital belief systems. There came a time when every major movement in the crypto chart was influenced by events far beyond mining difficulty or blockchain upgrades. News, regulations, social trends, global crises, and emerging technologies all cast long shadows across zones of imbalance. Yet those who understood the deeper architecture of supply and demand saw through the noise, recognizing that the market, no matter how chaotic it appeared, was always hunting for equilibrium between scarcity and desire. And in crypto, where assets could drop 20% in an hour or triple within weeks, equilibrium was never a resting point. It was a battlefield constantly torn apart and rebuilt. One of the most fascinating aspects of supply and demand in the crypto market is the way it intertwines with liquidity. Crypto, unlike traditional stocks backed by companies, operates in a decentralized environment where liquidity is not always evenly distributed. Some tokens are heavily traded, others barely move until a sudden wave of social attention pushes them into the spotlight. This uneven distribution creates zones of imbalance that carry emotional weight. When price approaches an area filled with liquidity, clusters of stop losses, pending orders, leverage positions, large players often engineer sharp moves to capture that liquidity, leaving behind zones of explosive imbalance. These zones become historical markers of manipulation and intent, areas where the strong revealed themselves and the weak were cleansed from the market. For the trader learning this craft, understanding why a zone formed becomes just as important as knowing where it formed. A demand zone created during a panic-driven crash may hold stronger weight than one formed in normal market conditions. The reason lies in the emotional intensity behind the orders. When thousands of retail traders, overwhelmed by fear, dump their holdings at the same time, institutions and silent whales absorb that fear as cheap assets. They step in where others step out. This act of accumulation becomes the birthplace of future rallies, and the zones they leave behind become sacred levels on the chart. When price later returns to those regions, the echoes of past fear create new opportunities for disciplined traders who recognize the footprint of strong hands. Similarly, in the crypto bull markets where euphoria rises to feverish heights, supply zones form as traders rush to secure profits before the inevitable correction. These are not merely reactive zones, they are proactive manuscripts of human behavior, etched on charts for future study. Every candle that shoots upward in a frenzy leaves behind areas where sellers waited patiently for the mania to peak. When price eventually spirals back after the bubble bursts, those supply zones often awaken like dormant volcanoes, releasing pressure and forcing price downward with striking accuracy. This phenomenon is a testament to the simple truth that history in crypto repeats itself, not because of divine patterns but because human psychology does not evolve as quickly as technology. Yet perhaps the most powerful, most misunderstood aspect of supply and demand in the crypto market is the behavior of whales. Unlike stock markets where institutional filings, public disclosures, and regulatory guidelines create transparency, crypto whales operate freely, often invisibly, leaving only faint traces of their intentions. They accumulate when markets are quiet, disguised through dozens of wallets, sometimes buying so slowly that price barely responds. But their presence builds the foundation of demand zones with such stealth that only the trained eye can sense the pressure beneath the surface. And when they decide to distribute, quietly unloading their holdings before a major shift, they create supply zones disguised within normal volatility. Traders who learn to identify these zones gain a glimpse into the shadow world of crypto giants, understanding the motives not through headlines but through footprints left in the form of imbalances. Through the years, each major cycle of Bitcoin has offered traders lessons in how supply and demand operate across time. During the 2017 mania, as Bitcoin soared from hundreds to nearly $20,000, supply zones became graveyards of broken dreams. Every time price attempted to reclaim lost highs, sellers who had been trapped earlier, those who bought the top and endured months of pain, unloaded their positions as soon as price returned to their break-even levels. Their relief selling created invisible ceilings that many newcomers mistook for random resistance. Yet supply and demand traders recognized these zones instantly. They understood that human relief is a form of supply as real as institutional distribution. When the 2020 to 2021 bull cycle began, those same zones transformed into critical areas of demand, as old resistances turned into newfound support through the psychology of acceptance and renewed belief. The 4-year Bitcoin halving cycle itself is a testament to the power of supply. When block rewards are cut in half, the rate at which new coins enter the market drops dramatically, creating a forced shift in supply dynamics. Demand, however, becomes a wild, unpredictable creature influenced by macroeconomics, global events, innovation, and social belief. Between the two forces, imbalance is inevitable. And imbalance is where opportunities emerge. Traders who study these transitions learn that supply zones around pre-halving peaks tend to weaken over time as new demand enters the market with renewed enthusiasm. Similarly, demand zones formed during deep crypto winters tend to act as long-term support regions for years, offering some of the cleanest entries available to traders patient enough to wait. Each altcoin, too, carries its own unique story, a story of developers, investors, speculators, believers, and opportunists. In some cases, demand zones form because a project releases groundbreaking technology or signs key partnerships. In others, supply zones strengthen because the project loses trust or faces regulatory scrutiny. Even meme coins, often mocked for lacking fundamentals, obey the laws of supply and demand with surprising precision. When millions of traders rush into a meme coin during a social frenzy, supply zones form quietly through whale distribution. When the frenzy ends and most give up hope, a quiet accumulation period begins again at deep demand zones where whales buy cheap tokens in preparation for the next cycle of hype. In this way, even the most irrational corners of the crypto market express the same mathematical truth that guided ancient markets: scarcity increases value, abundance decreases it. Understanding these repeating patterns requires more than technical skill, it requires emotional discipline. Crypto markets test traders ruthlessly, rewarding patience and punishing impulsiveness. Demand zones often appear strongest right when fear peaks, when news is catastrophic, when social media screams collapse, when markets bleed red. Yet history shows that the best opportunities often lie hidden within those moments of fear, waiting at the base of deep demand zones that formed long before panic set in. And supply zones often hold firm at moments when confidence is highest, when influencers call for never-ending rallies and new traders believe the market can only go up. It is in these moments of euphoria that supply zones awaken, rejecting price with the force of collective profit-taking and whale distribution. For the trader, mastering supply and demand in crypto becomes a journey of self-mastery. He begins to recognize that the chart is not merely a set of lines but a mirror reflecting human behavior in its purest form. He sees how hope creates demand and fear creates supply, how greed pushes price into danger and how caution preserves capital. And as he studies deeper, he learns to anticipate the future not through prediction but through understanding where the battles of the past were fought, where the scars remain, where the giants acted, and where the quiet footprints of imbalance still echo beneath the surface. And if this journey through the heart of the crypto market brought you clarity, insight, or even a spark of confidence, then take a moment to support this work. Like the video, share it with someone who needs it, and subscribe so you never miss the knowledge that could shape your next move. Your engagement doesn't just help the channel, it keeps this learning journey alive.